All right. Good evening again, guys, and welcome back to, the completion class for the topic we started few hours ago, financial statement analysis. And can anyone confirm you can see my screen?
Yes.
Yes,
Yes, sir.
Oh, okay. Okay, great. If you have not been paying attention, maybe in the calculation, perhaps there are things you can easily go through the formulas and understand. I think this 1 hour, the next 1 hour, you need to pay maximum attention. Yeah, you need to pay maximum attention because it's just to talk about some specific things we need to pay attention to. So you don't want to, be doing what your examiner is not expecting, and you want to be able to analyze numbers in a way that makes a lot of sense. So we've looked at all of these, defining financial statement analysis, different tools that we use, horizontal, vertical, and the combination of both, common size and ratio, different categories of ratio like we have here, the ratios under each category, and we've examined the formula for each of the ratios, in much detail. And what we want to do next is to, talk about interpreting ratios. And let me mention that how well you are able to interpret your figures, right, actually shows whether you are a good analyst, or whether you're a good analyst or not. Um, whether you're a good analyst or not. So I've put in a very short example on the screen, which I'll just walk you through now. And then we can start, reviewing a whole lot of other past questions and not just to get more insight. So let me work with this same example first, right? If you take a look at this example, is me having an SOFP or income statement extract and balance sheet extract in here. And I have 2 years, 2018 and 2019, from sales down to profit after tax for the income statement. And for SFP, I have an extract basically showing me that, okay, maybe they don't even have any liability on an assumption. But let's say they basically have a total asset, and this total asset is also equating the share capital, share premium, retained earnings, and the reserve that they have. And that's all they've got. An extract just to focus on the aspect we want to discuss. Okay. And if I say, okay, let's compute just 3 ratios, which is 3 profitability ratios: return on capital employed, gross profit margin, net profit margin, and asset turnover. Remember, I mentioned something earlier that net profit margin multiplied by asset turnover should give us ROCE if we've used this formula, except if you are using any maybe variant that is not aligning in terms of the variables, right? So if I go ahead to calculate, so ROCE again, how do you think I calculated my ROCE for 2019? Somebody talk to me. How did I calculate my ROCE? You can mention the numbers, maybe this divided by this, just to see if you still remember,
I think it's earnings before interest and tax
which is
divided by which is 50,000 divided by capital employed,
which is
it,
6 to 7,000.
6 to 7,000, and that's correct.
Okay.
as you can see. Now, take a look at. And my net profit margin, how did we determine that? Just the numbers, just mention the numbers.
That's
2019.
2,000
over 380,000.
Over
divided
380?
by 80.
Did I
Yeah.
hear 380?
Yes.
Okay.
3,000 divided by 380,000 times 100%.
Okay, correct. I just wanted to be sure you didn't say 280. And the last one, asset turnover.
That's 380,000 over
380,000.
60,000 divided by 67.
380,000 divided by 627, and that shows that number. So, and that's it. The way we've been, discussing in terms of the formula. And then we did that same thing across the 2 years. We did the same thing in 2018, right? And we want to interpret these three numbers across the 2 years. And I put a note here to guide you on how you need to interpret really sometimes, just to have a comprehensive analysis. And I said, when you want to interpret ratios, you start by making comment on the number, say it as it appears, right? Say it as it appears. So so the fact that it is that way doesn't mean it's automatically a conclusion. You need to open your eyes again and say, you're an expert in this case. You're a professional. I think that's the right word. You're a professional, right? So you cannot do a financial analysis like an engineer. You cannot do a financial analysis like a pepper seller in, or in the market, right? You cannot analyze numbers like a politician. You are a professional. You are an accountant. You are a finance professional. And we need to see that in your analysis to show that, yes, you know what the number, you understand your numbers, right? So I said, make comment on the figures, take a deeper look, state possible reasons for the changes, conclude on the ratio. So you need to do a whole lot of things before you just conclude. It's not for you to just do and then you're concluding that it's bad or it's good. I mean, be careful. And that's all we are saying. Okay. So if you look at this now in relation to this guideline that we have here, and let me just walk you through. Let me make a casual comment first, and then we can coordinate it. So if I look at these numbers, I'll probably see that ROCE is my overall measure of profitability, and that decreased from 8.33 in 2018 to a 7.97 in 2019. And a further look at the component of ROCE, which is net profit margin and asset turnover, uh, shows that net profit margin. Okay, so I will take it this way because I've seen those two figures. I can see that the decline in ROCE is actually more attributable to the decline in asset turnover. I can see that, as you can see, it declined because asset turnover declined from 0.3 times to 0.61, despite the increase in net profit margin from 11.43 to 13.16. Okay, interesting. So now, ROCE decreased. That decrease, I can only attribute it to the decrease in asset turnover, despite the slight increase in the net profit margin. And that's my comment so far. And sometimes I'm wondering, okay, how come it now fell? Okay, maybe it could be that the increase in the asset turnover is stronger in terms of weight compared to the decrease is stronger in terms of weight compared to the increase in net profit margin. But it might make sense to look further and understand what has actually happened. So do you know that at this level, our analysis is showing that this company has really done bad in 2019 compared to 2018. Speaking to this ratio, the overall measure of profitability is is ROSE, and ROSE is showing it. In fact, one of the components of ROSE is also showing a decline, which is, if we want to even interpret the asset turnover alone, we will speak on the figure and say this company has not really done well in 2019 in terms of asset utilization compared to 2018. But don't make those conclusions yet. So take a deeper look. So now, if I want to, I've been able to narrow it down to asset turnover, and I want to look at my sales. What happened to sales? I can see that my sales increased from 350 to 380,000. How come my asset turnover now declined? Right? Okay, maybe we employed more assets to generate this revenue, because I know that my asset turnover is a function of my revenue and my capital employed. Right? So I've seen it that my revenue increased from 350 to 380. Let me also look at my total assets. My total asset also increased, more significantly. The asset turnover, the asset I employed increased more significantly, 31%, and revenue only increased by 9%, and that is what is responsible for the decline in asset turnover. So I probably want to look at it. Okay, ordinarily if assets increase, our revenue is supposed to increase. The increase is supposed to commensurate the increase in our assets. I hope I've not mixed it. Assets, yes. So the increase in revenue is supposed to be in line with the increase in assets, right? But that should only happen if we have acquired assets. If I take a further look at the numbers, right, a further analysis tells you here that you need to be more careful, because I can see the breakdown of the asset that I have employed, or the capital that I have employed, showing that my revaluation reserve increased from 15,000 to 137,000. And that represents over 800% increase. And that is the only reason I can attribute from these figures I'm seeing here to be the reason for the increase in the asset employed. Do you know what this means? You didn't buy a new asset, though. You didn't buy any new assets. The increase in the asset that impacted on the asset turnover calculation is as a result of this revaluation surplus. And from your accounting standard, you know what revaluation surplus is. The same asset, in line with IAS 16, you revalue it, right? The same asset, you revalue it upward. Then you recognize the reserve here, and of course the income in the income statement as well. Are we together? So there is no actual increase in assets. Therefore, you should not expect this increase as a result of revaluation surplus to translate to a proportional increase in revenue. So if you consider all of these things that you've now been able to identify, and take a look at the fact that your revenue actually increased, in fact, your gross profit even increased also, meaning your cost of sales is not even a problem, and profit margin shows you that. Because even after you look at your OPEX increased, as expected, from 40 to 50K, and then your EBIT from 40 to 50K. Everything increased, and that is what is showing in your net profit margin. Right? So even though ROSE is a measure of overall profitability, and an indication shows that a decline in that ROSE is more attributable to asset turnover, because the company has employed the value of the asset employed during the year, has increased significantly. But this does not translate to underperformance compared to previous year, as this increase is only due to the revaluation surplus. So you want to conclude from everything you've seen, has this company done well or not in 2019 compared to 2018?
Has done well.
They have done well. Did the ratio say that they have done well?
No.
No.
No. The ratio says they did bad. But you are saying they did well. It is what it is. Sometimes in your question, it could be that, oh, something happened in the additional information. They gave you something, one line to tell you that they decommissioned a particular asset, or they discontinued a particular operation, or they, watch out for those information. What is the impact of it on the overall financial statement? So that when you are computing your ratios, you are not interpreting solely based on your calculation, but you are corroborating all the information you have been provided with to make more sense with your figures. It's very important. Are we together?
Yes.
Great. Before questions. So this same interpretation, I only use this as an example, right? Maybe we'll dwell more on, let's say, we'll also go and dwell more on this efficiency as well, right? But it can apply to all aspects like that. We're just saying you open your eyes like this. And because you are a professional accountant or a finance professional, you should be able to see what an ordinary man cannot see. You should be able to see what a layman cannot see. You can see that to do this now, we're able to understand because we know that there is a standard, IS 16, that tells you that it's either you do a cost model or revaluation model. A revaluation model could help you to increase the value of the asset. When I see revaluation surplus, I know that's where it's coming from. You didn't buy any assets. You revalued your assets. Are we together?
Yes.
Very important. Very important. There are a whole lot of things that can happen as a result of that. Imagine a situation where you make your revenue, then towards the end of the year, they tell you that they sold a particular branch, they closed the particular branch, they have operated for 9 months during the year. It means that branch has even earned 9 months revenue or 10 months revenue close to a year. But the remaining last 2 or 3 months before the year ends, they decommissioned or discontinued that operation and they sold the asset, meaning that asset is now removed from the PPE. Do you know what that means? Your PPE at the year end will now reduce. Meanwhile, that operation that was discontinued has impacted on your revenue to stay at the level that it should be. By the time you now calculate your ratios, those things will now make it look abnormal. It might turn things upside down for you. You must consider that in interpreting. Very, very important. And the way it is, they will give you all numbers, but additional information they will tell you these things is left for you to know the implication. Oh, efficiency now. Something happened. They are not able to get, they try to, they try to bargain with maybe the customers to tell them if they pay early, they will get an early payment discount. They will do this. They are able to boost revenue. So what is the implication? What are the areas it could impact? It could reduce the payable days to the barest minimum, but impact on what? The revenue. It could be impacting on the revenue by reducing. It depends on the industry now and the elasticity, really. But it could impact on the revenue negatively as well because you give early payment discount. Do you know the impact of discount? All these discounts that we give to our students, do you know the impact? Right? So it could impact. But at the same time, it's all about what the company is managing because you need to look at it from, okay, you are doing this to be able to manage your turnover period and your liquidity. What about the profitability? Right? So a reason for a drop in profitability could be that discount. I said it depends on the industry, it depends on the product. Some discount can attract more sales. Some discount can only increase turnover in terms of this efficiency. Your collection early might not really increase sales like that. Those are some of the things you need to check properly. right? So if you have a discount like that have dropped your revenue, but at the same time it has really helped you to improve your liquidity, I mean, it might be good. It's then a question of which industry do you operate. Is it that liquidity is that important than profitability in your case? Or in your own case, maybe liquidity is not even a problem. Then you shouldn't bother. Why should you give discount? So you have to understand the industry you operate. You have to understand the information you have been given, how it impacts on the numbers. And, let's check out, I mean, for case study, guys, we have a long way to go anyways. But let's check out some past questions. But before we start, opening past questions, I think we can have one or two questions and then we can proceed. We said we want to be done by 8. Precious.
So it's just a confirmation from where we stopped before we went on our break. So I just wanted to confirm. Let me write it down. Okay, yeah. So I just wanted to confirm that the under asset turnover, so we say sales over capital employed. The capital employed there that is used is similar to the debt to equity plus debt.
Debt to equity plus debts. The capital employed is equity plus debt. Yes.
It's the same. All right.
Yeah. So the only thing is that when you now get to the reality, I mentioned something like, if you look at the analysis I did here, where somebody is getting 91182, somebody is getting 91299, and that's coming from the fact that someone might just be looking at it as it is to say capital employed is my total assets minus current liability, or equity plus what is your definition of debt now? In that case, somebody can decide to work with the entire non-current liability as the debt. So that person will do 62 plus 28 and it gives 9182. Somebody can decide to say it is debt. I'm interested in debt. Let me start looking for the debt. Okay. Equity plus this one is a debt. Deferred income. No, I'm not picking it. Contract liability. This one is a debt. Deposit for share. Okay, is a debt. And maybe I want to work with that. Somebody can decide to. Do you get the gist now? And that is how the other person got. What did we get? Did we include this one? What did we include? And what did we not include? That's how we got. Let me just highlight it. That's how we got this one. Okay, it was because we included the current aspect as well by saying this borrowing that is under current liability, because I understand it well, is also a debt, even though they are hiding it under current liability. You get the gist now.
Yeah.
And this is coming from the fact that you also understand some standards where, you might have treated some things, you then try to break it into current and non-current components, but before breaking it, loan alone.
Yeah.
Do you get? So those are some of the further analysis you can go through. And I've made it clear that, see, you can choose to be very detailed. Case study, guys, I discourage it a lot. Don't give me detailed. Hey, you're now too high level work because they are chasing you, So your time can never be enough. So don't try all this. You are picking this, doing this. Everything, all the calculation can only earn you 10 marks in case study. So it is your report that matters, right? So but I'm just saying that people can really be very detailed to say, okay, it is equity plus debt. I really want to scrutinize to pick out only debt. Right, and that's what I have said. Okay, where are we? I think we're going to look at past questions and then any other question, maybe one more question before we start. And I think we'll start on a very light note with maybe one or two questions from skills level, and then we navigate to professional, and then we can spend some few minutes to speak to case study guys. And that's it. So in the next 30 minutes, we should be done.
30 minutes?
Yeah. We don't have much to do now. So because the way it is ratios are garbage in, garbage out. You plug in the formula and then you arrive at your final answer. Let's go. So let's start with FR. And let's start with this November 20. Somebody please take gallant and be ready to help us read questions. So let's start with questions. Is it 2 or 3? Let's start with this. This is something you should be able to close very easily. Somebody read for us. Question 3. November 2017.
The basic financial ratios can be
Are you in skills level? I need someone from skills level to read.
Yes, from
Basira,
skills.
go ahead, please. Thank you.
The basic financial ratios can be grouped into the following broad categories: profitability and efficiency, long-term solvency and stability, short-term solvency and liquidity, shareholders' investment ratios. Required: briefly explain the main aims and give 2 examples of each category of the above financial ratios. 8 marks.
Tell me that
B.
you cannot end this 8 marks and I will kick you out of this class.
B.
Somebody just tell me that. No, let's address this one first. Somebody just tell me that you cannot fetch the entire 8 marks, that you will lose 1 mark and I will kick you out of this class.
I'll lose one.
Let me look for your name. I'll remove you. Okay, so that was just a joke anyways. But this is a very straight question, if you agree with me, right? So it's in line with what we're talking about the other time. 8 marks. If I look at it very well, so they want you to be able to do what you do in each, we earn you 2 marks. So you define it, very simple, mention, give example of 2. But let's do it quickly. This one is, we should be able to run through it, and I'll call names randomly. Abimbola, let's start with you. Pick profitability and efficiency. What is the ratios all about? And give us examples.
So my background is a bit noisy, but
Manage it like that.
profitability ratio measures the financial performance of the company over a period of time.
While efficiency,
Efficiency measures the effectiveness and efficiency of the company's operations in relation to working capital.
great. Examples.
Example of financial performance, we have ROCE, gross profit margin. I'm guessing 2 each of it.
That's
For
okay. Then
efficiency,
just give us 2 under efficiency as well.
receivable turnover period, payable turnover period.
Is this the first time you talked in this class?
No, what was the question?
Did you say something earlier? I'm just trying to remember.
Yes, I did.
Okay, but I just want to tell you that you've really done well, and it shows that you really paid attention in this class. Thank you. Someone else, I'll call another random name, right? On long-term solvency and stability. Long-term solvency and stability. Fatia.
Good evening, sir.
Yeah, good evening.
Okay, so the long term solvency ratio is talking about the debt to like the debt and equity components of the company, how the company is able to resolve their debt faster, I guess.
Okay, how the company is basically able to meet their long-term obligation. Okay, examples.
Okay, an example is the debt to equity ratio,
Debt to equity ratio,
um debt to interest cover,
interest cover, which is, do you remember the formula?
No, sir.
Okay, EBIT over interest expressed the number of time. That's a very good attempt. Well done. And the third one, very quick now. Anyone on the third one? Just go ahead straight. Short-term solvency and liquidity.
Okay.
Let me go.
Okay, Charity, you are going to go ahead. Yeah.
It speaks on how
Okay.
an entity is able to. It speaks on how the ability of an entity to be able to meet its short-term obligations. And
Fantastic.
an example is the inventory turnover period, and also the receivable turnover period.
Period. Afis, you are going to speak. Is that fine by you?
Okay, maybe just to add to the examples, right? Under that we have the cash ratio and the liquidity ratio as well.
Okay, so you should not be adding, you should be stating your own, because what you said is correct, but she was correct with defining the purpose of the ratio, but she mentioned the ratios that falls under efficiency. Please take note of that, Charity. Yeah, so the
Okay,
ratio
thank
you
you.
mentioned, Afis, are the examples under liquidity and short-term solvency.
Okay, maybe I
Acid
should
test. Okay. Acid test. Go ahead. Just go ahead.
These are ratios that shows how companies are able to meet their short-term obligations.
Exactly. And then you mentioned current ratio and acid test,
Liquidity.
including cash ratio. All right. And then the last one, let me pick that one, is just to, we said shareholders investment ratio. And we said these are ratios that shows how well the company is performing in relation to stock market. Examples are EPS, DPS, PE ratio, earnings yield, dividend yield, payout ratio, all of those ratios that we listed, in the last aspect. Just mention 2 and move on. 8 marks. Quick one on the B part. Somebody read through.
Okay. The following is the financial information extracted from the records of ACCA Nigerian PLC for the year ended March 31, 2017. Okay. All stated there: inventories, finished goods, purchase, revenue, cost of goods sold, trade receivables, and trade payables. Additional information. The directors of ACCA Nigeria PLC are of the opinion that the average cash operating cycles of the company that operates in the same industry as ACCA PLC is 75 days. Required: 1. Explain the term cash operating cycle.
Somebody,
2.
What is cash operating cycle? Somebody, quick.
It's how long it takes to convert our inventory to cash.
Inventory?
Working capital.
It's how liquid an entity is. How an entity is able to convert
All right. Let's not give chorus answer. Maybe we can raise our hand now, but it's fine. Okay, so Sam Love, you can go ahead. Just explain cash operating cycle to us.
The cash operating cycle is the numbers of days to convert our inventories and receivables into cash.
Inventory and receivables. I think you can mute now. Yeah. So inventory, receivable, correct, but it sounded like you missed out payable, and that's why it's always safer to just look for a way to capture all of them together. You could say the number of days it takes you to convert your working capital, to cash, really, and that captures it all. With that, we know you are referring to payable, receivable, inventory, all of them all together. But that's fantastic, right? And I mean, that's all they need. Maybe you probably want to even do paparazzi and explain, oh, the longer the better or the shorter the better. But you don't need that, because I guess that's what they want you to apply to earn more marks here. So let's take a look at B part. Who was reading?
Okay. B. Calculate the cash operating cycle of ACCA Nigeria PLC.
So what is cash operating cycle? What's the formula?
Inventory days plus receivable days minus payable days.
Inventory days plus receivable days minus payable days. And this is it here. Thank you for that. And we showed you here. Where is that? This is it here. Inventory days 65 plus receivable days 45 minus 67, which is payable days. Which is payable days. Okay. Okay, it's good that we have this solution here, Sam. I think we can easily use it. I think this is it. Is it? Let's see. It should be. So they said we should calculate it. So how do you think? So what's the formula for inventory? Now they gave you breakdown of the inventory. They gave you inventory of raw material. They gave you inventory of work in progress and that of finished goods. So there are two approaches you can use to do this. Somebody can decide to say, I don't have time, especially with the mark you've awarded. I don't really have time, but 4 marks is plenty. 4 marks. You probably want to do it individually. Do separately for raw material. And for raw material now, how do I get the inventory turnover period? Somebody now, tell me the formula. So you don't need to do average. So no stress. It's just 1 year that you have. Can you see that? Or will you do average? If you want to do average, how? Do you agree with me that I don't need to do any average? I just work with the numbers that I have. Do you agree?
Yes.
So inventory turnover period. I said one method I can use is I will just sum up these three inventory. 142,000, 57,000, 190,000, and I will just divide it with cost of sales, which is 712. Can you see? And I have my straight inventory days. But you might need to break it down by saying, by working with the raw material inventory, right? That will be divided by what? To get the raw material inventory days.
Cost of goods sold.
Because you can choose to work with cost of goods sold, but that will not be appropriate because cost of goods sold relates to your overall inventory. So it is more appropriate to work with purchases. Please take note of that. Yeah. So those are some of the flexibilities you need to add to your calculation. So it is more appropriate to work with purchases. So in that case, let me see if that's what we did here. Raw material. So I can easily say, is that 475? Is it 475 we have? Yes, 475, exactly. So it is better to work with this. So meaning my raw material inventory days, let me write it in full. Yeah, I think that's what we wrote here. Raw material inventory turnover period will be 142,500, which is raw material inventory divided by purchases, which is 475,000 divided by 365. And then what about the second one? Work in progress. What do you want to use? That one now is in the middle. So what do you want to use?
Purchases.
Do you prefer purchases? Some work has gone into this. So I will prefer to work with cost of goods sold. Let me see what we worked with here. We still worked with purchases, right? We work with purchases, but if I work with cost of goods sold, I will not be wrong. Can you see that? So you just need to state your assumptions clearly if you're making any assumption. So here we are probably assuming that it is closer to, raw material than finished goods. I hope we are following. Remember the first thing I said, I can decide to even do it together by not doing it per inventory type. So especially if the mark is very small. Then the last one, obviously, that one is finished goods. That one will be on cost of goods sold. Do you agree?
Yes.
Good. And that's what we must have done here. 712,500. 190K divided by 712,500. And that gives us 97 days. 97 days. And what about receivable turnover period? Somebody compute it and give us the answer. Receivable turnover period. Receivable turnover period. Who has gotten the final answer?
93 days.
93 days. 93 days. What did you do?
Trade receivables over revenue times
Thank you.
365.
Thank you. And it's as simple as that. So that 93 days. So how did you get this 88 days for payable days? So what did you do? Let's check that out. They got 88 days. How are we supposed to get that?
So trade payables over cost of goods sold times
Trade
365.
payable over cost of goods sold. Do you want to confirm that? 88
Or
days.
purchases.
Divided by
Purchases. Thank you. Purchases. And that's basically it. So the moment you've gotten everything like this, you can sum it up to have your cash operating cycle. To have your cash operating cycle. Now, I need you to speak to this. I need someone to raise their hands and I will call someone to speak to the final answer. So raise your hand if you want to speak to that final answer. So read the additional information and speak to the final answer. Raise your hand. Let me call you to do that if you're interested. Or I'll call names randomly. Hmm? Okay, so we have Adebimpe. You want to speak to the final answer? Very good. So read the additional information and speak to the final answer, please.
Okay. The director of UNWOKK Nigeria PLC are of the opinion that the average cash operating cycles of companies that operate in the same industry as UNWOKK PLC is 75 days.
And our own is what?
It's
256.
256 days.
Speak to
So
the number.
that is way above the industry average, and it shows that they are cash operating they take more time, to be able to convert their working capital into cash, which is not a very good indication when compared to the industry average.
Thank you very much. What a perfect analysis. Still, you, Adebimpe, you know this year we analyzed is 2017.
Yes.
You know this year we analyzed is 2017.
Yeah.
And let's say that you now analyze in 2018 and this number has actually improved drastically to 160 days, right? I want you to reinterpret the 2 years in line also with the industry average.
Well, even though that their cash operating cycle has improved, it is still below the industry average. So when compared to the industry average, OKK still has a long way to go, in ensuring that they are able to convert their working capital more faster, if possible, even below what the industry average.
Fantastic. I'm satisfied, right? The only thing you then want to do is you want to bring in these. You want to bring in these. Where is that page? You want to bring these to it to make sure that you do things appropriately. Don't leave the part where we said comment on the figure. You want to start by telling us that the cash operating cycle is 256 days in 2017, and this improved significantly to 160 days in 2018, even though this is still below what? The industry average, right? And then it is from there you can be adding again that they can do better to, and all of those. So very, very important. So taking it from there, let's say something. Yeah, is the question. I know the question is also testing. Let's look at the last part. We've addressed this number 3 now. That's what you just addressed, Adebimpe, the 2 marks, that you should assess the company's performance in relation to the industry average. So you've done that, right? So let's now look at the 5th part. Is it 4th part? Somebody read it for us.
Suggest 2.
Oyindamola, I think your network, or is it mine? Can anyone hear me?
Yes, we can hear you.
Okay, so that's Oyindamola. She wanted to speak, but we couldn't hear.
Can I go now? Can you hear me?
Yes, go on, please.
Okay, I said suggest 2 steps that should be taken by the directors of ACCA Nigeria PLC to improve the cash operating cycle of the company.
Okay, very good. So this question, I deliberately looked for this question. And this question is tested at skills level, but this question is very, very important for professional guys, this particular one. For case study guys, ICAN has consistently test efficiency ratios, right? And when efficiency ratio is tested, this part, you see this part, what we did in these 2 parts is very critical to you being able to earn marks around it, right? Because the things that you now see in your conclusions and recommendations are the things we are talking about in this Roman figure 3 and 4. Are we together? So let's pick it up. Suggest 2 steps that should be taken by the director of the company to improve the cash operating cycle of the company. Somebody raise your hand before you speak. Let's allow Hafiz to go ahead.
Okay. Offer the early payment discounts.
Early payment discounts to those guys to improve. Which one now? Which one? Which one are we trying to improve?
Receivables.
To improve receivables. To improve receivables. Okay. What else?
Negotiate payment favorable payment times for their creditors.
Negotiate further with creditors to see if they can give you a favorable payment terms that can help you improve your payable days, right? More. I want at least one on inventory so that we know we touched the 3.
They can reduce the level of inventory they keep in store, depending on, since it's taking them so much time to convert it, it means they don't even need to incur the holding cost and even keep that much inventory in the first place.
Oh, so if I get the first thing you said, did you say they should increase the inventory or reduce it?
I said they should reduce because it
Okay.
has 2 parts. Number one, there's holding cost, depending on if they are using a warehouse where they are paying for to keep the inventory. And also, since it's taking them so long to convert it, it means they don't even need that much inventory to keep part-time in the first place.
Okay. Fantastic. And then maybe to wrap it up, you may also want to add.
Can I? For the inventory, depending on the kind of product they do, they can introduce a just-in-time system,
whereby everything is just flowing like
yes.
like river, come in, go out, come in, go out. That's fine. And everything still depends on the type of business we're talking about, right?
Can I add
for this business, okay, looking at it, looking at our finished goods and looking at our raw materials, so I think they had more excess of their inventory, like they had excess, so probably that's the reason.
Okay, if I get you now,
Relatable.
they keep a lot of finished goods. Maybe we need to also add the suggestion on them improving on their marketing and maybe embark more on spending on marketing to really get all of these things out of their inventory. You know, we never can tell what they are not getting right? So we let's just keep it at that so that we can continue because of our time. But thank you for all the comments. I mean, really wonderful. And you know, that's the kind of that's the kind of thing I expect. And that's what I also tell my students. I say, go to the exam and hustle. It is not all the questions that we expect that, oh, I saw it in page 500 of my FR pack or CR pack. No, a lot of questions just requires you to think that, oh, okay, just make sense and earn your mark. And it's as simple as that sometimes. So I think that's basically it for this question. We're able to do everything. Okay, interesting. So one more, last one, just a quick one. Anyways, we are not going to spend more than 5 minutes on it. Another one on, I think that should be. Let's look at this one. Look at this question before we go to professional level. Look at this question. Question 3. So this question says, Magifera PLC had been trading in merchandise for several years in Garden City. The information below relates to extract from the financial statement for the past 2 years, right? And then they gave you a statement of profit or loss and other comprehensive income for the year ended 30th September 2015 and 2016, right? All figures in million and assumed correct, right? And now you can see the income statement, you can see the balance sheet, and they said total equity and liability. The board of directors were worried over the dwindling financial performance and precarious financial position of the company. The products are aging. The economic depression is biting as a result of worsening exchange rate of 1 to 400. Wow. Oh my God. Each time I see this. Okay, interesting. Exchange rate of it was
Oh yeah.
Let's just move on, please.
okay, interesting. I saw the exchange rate. It just reminded me that this is just few years ago. Okay, the company imports 60% of goods sold in Garden City. The worsening exchange rate had affected the company's importation. Consequently, the revenue of the company dropped significantly. The unsafe financial performance has also affected the market price of the company's shares, which dropped from 12 kobo per share in the year ended 2015 to 8 kobo per share in 2016. Now, all this information is not just there for, there are information that have been provided for you to corroborate with what you are going to do. I hope we are together. And that's what I was talking about earlier. So at the end of the day, they told you that you are required to calculate the following ratios for the year ended 31st December, 30th September 2015 and 2016 in columnar form, 2 years. And they specify the ratios you need to compute, which is very fine. They specified. Return on capital employed, total asset turnover, quick ratio, debt to equity ratio, fixed interest cover, earnings yield, price earnings ratio, dividend cover. I mean, not a problem. And then they said, write a report and formal technical report to the board of directors to assess the performance, categorizing them into performance, liquidity, stability of the company, using only return on capital employed and asset turnover, and quick ratio under liquidity, and then fixed interest cover and debt to equity ratio under long-term solvency. And that's it. Eight marks. I have meeting in 30 minutes time. Interesting. That's 8 mark to interpret. And this is a very simple question. I think I would just want you to calculate only the first one, and then we go and use the professional guy's question to do more of the interpretation. So I need somebody to just look at this and tell me what let me reduce the size. So tell me what the return on capital employed is for the 2 years. Oh yeah, let's go. Ife, are you there? Can you hear us? Okay. If you can hear me, your background is very noisy. Please ensure that you are muted so that you don't distract the class again. Somebody is computing our return on capital employed for us. What is your answer? Okay, so let's break it down. What is your EBIT in 2016?
22,500.
45,000.
What is your EBIT? I like the way it's presented.
22,500.
500.
23,
21 to
21 to 50.
500.
22,500.
250.
In what year, please?
All right. Who wants
32,500 in
32,500, 21 to 50, 22,500. I will need to I don't need your answer again. I think I've gotten enough number. Okay, so that you can mute now. Very simple. I have my revenue. I have my gross profit. I have my admin expenses, but they didn't show me gross profit. I can see finance cost deducted, and they gave me 23,750, but this number is profit before tax. They have already deducted interest. I'll pick this number and add back my interest, and that will give me 25,000. Am I correct?
Yes.
Yeah.
Good. So it's 25,000. That is your EBIT. Take a look at it. It should be clear now.
Sir, please come again.
I'm looking for my EBIT now. Earnings before interest and tax. So what they gave me here. Sorry. What is this one? This is what I was going to pick. 21,250.
Exactly.
So I'll pick my operating profit before tax, 21,250, and add back my interest, which is 1,250, and that will be what in total?
22,500.
22,500. That means those that mentioned 22,500 is very correct. 22,500. Very simple. So this one as well, I'll pick my 41,250 and add back interest, and that should give me 42,500 as well. So that's for EBIT. The next thing I'm going to ask is, I think you can keep question. Let's give it some minutes to land before we attend to questions. The next thing we are going to look at is asset capital employed. So what is my capital employed in this question?
52,700.
52,700 for 2016. What about 2017?
Yes.
2015?
47,500.
Very simple. Therefore, my return on capital employed for year 2016 is 22,500 divided by 52,700 times 100. Like express it in percentage, and you're fine. So I don't want us to waste much time, because every other ratio is just for you to be careful in bringing out your numbers like this and apply the formula the way we've gone through it. So if you want to check through the solution quickly, you will see that it's just which question number was that? Number 3. Yeah. So you will see that is exactly what we've said. To say return on capital employed is as simple as PBIT, that's EBIT, the same thing as EBIT, over capital employed. You will see that they added as we did, divided by the 52,700, they got 42%. And the same thing for the previous year, and that's it. So the only thing you need to take note of is the fact that they said total asset turnover. They didn't use the word asset turnover where you are supposed to use capital employed. So in that case, it will be turnover over total assets that was used. And that's the only difference between what they did here and what we have. What we have is asset turnover. If you do what we have in the Excel sheet, they won't mark you totally wrong. I've emphasized on it for you that all you need to do is to be consistent. Very, very important. And then quick ratio, just as usual, take out your inventory from your current asset before dividing with current liability. And I mean, it's as simple as that, really. So any question now before we start looking at a more, before we look at a more 1 hour is past, a more robust question.
I have a question. My hand has been raised.
Yep, go ahead,
So
Julie.
please, if you can scroll back to the question. Yeah, my question is regarding the EBIT. I got 22,500 as well. But in a case where there are other non-operating expenses,
Yeah.
would I have been correct to say, please scroll up a little, please, to the previous page. Would I have also been correct to say gross profit less admin expenses?
No. Gross profit less all expenses except finance cost.
Yes, but in this specific question.
Oh, but you said in this specific question, you
No,
said
something
in
in this
another question,
specific
if you are
question.
given.
No, in this specific question, 45,000 less 22,500. But where there are other non-operating
Non-operating,
expenses.
like an example now.
So you said it should have been 21,250 plus 1,250, which gave us 22,500.
Yeah.
So what if there are other expenses like maybe selling and distribution?
Yeah, that's still operating.
Which
That's still
non-operating?
operating. So if they have deducted, let's say there is distribution expenses now, they would have deducted it too before arriving at 21, right?
Yes.
I'm fine with that. So
Yeah.
all I still need to do is to pick that number that they arrived at here and add back only interest. The only thing I don't want them to deduct is the interest, because the profit says profit before interest and tax. So you cannot deduct those two. I need the number before you deduct those two. Does it make sense?
Yes, it
So
does.
if interest have been deducted, add it back. So a normal template will show you a bit. This one did not show you a bit. You need to work it back a bit. And that's what we have experienced in this question.
Thanks.
Yep. Alice, you want to go ahead quickly before we...
Please, I have a question.
You need to raise
Okay.
your hand if you have questions, please. Very, very important.
Thank
Especially
you.
with the
So
fact that we have... Yeah, go ahead.
in the formula you have given us, right, to calculate capital employed, you made mention of a total assets minus current liability or total equity plus non-current liability. But if you look at this question, I'm finding it hard to apply the formula.
We just picked it now. Look at here. They said equity
Yeah,
and
we just
liability. Can you see the nature? Okay, let me explain. Equity and liability. Equity and liability. They put ordinary share capital, retained earnings. Those are equity. Then 10% loan notes, 10% redeemable preference share. Those are non-current liability. Added together to have equity and non-current liability of 52,700. If you also go the other route of saying total assets 96,500 minus what? Minus current liability 43,800, you get the same answer.
No, if you're not.
How? It will now.
Total assets is 6,005.
Minus
current liability is 43,008.
So that will give.
So that's not going to equate 96,005.
That's not supposed to equate 96,005. You said, okay.
But that is
There are
what
two
we
ways
use
to get your
total.
capital employed, right? Hello, can you hear me? Okay, you need to speak so that I'm sure we are together. Okay, so we actually need to pay attention. There are two ways to get your capital employed. One is your total assets minus current liability. In this case, it will be 96,000 minus 43,000. That will give you 52,700. That is the same thing as the second method, which is equity and your non-current liability, which is what we have presented in this line. So anyway is a way. Are we good?
But in our solution, 96,005 was used.
Which solution? The one we just checked? Question number what? Question number 1 now. This is 52 now. Look at it. Are we fine now?
Yeah, very well.
Yeah. All right. So that's basically it for that question. Let's dive into a more and utilize the remaining few minutes we have. Let me check this. But before this, just for professional guys, sometimes you can get something. This is professional level corporate reporting. And we have also seen from the past question trend that this is everyday thing. So you need to be set. And the funny thing is, it's always in question 2. So sometimes they shift it to question 3. So it's almost like 100% certain they are going to have it. So imagine seeing a question like this, where they said AZ is considering raising external finance through offering it to its shareholders for sale, obtaining a term loan from the bank. To this effect, the last financial statement of the company for the year ended 2021 presented below have been subject to financial analysis. And then they gave you income statement from profit before interest and tax. They didn't give you revenue, down to retained profit. They also showed you the dividend that has been paid. Take note of that. And I can see that they paid a constant dividend, irrespective of the fact that they reported the same profit. Anyway, they are different profits. And then we have a balance sheet showing us a non-current asset value, a current asset value, equity, non-current liability, and all of this number. And they said compute the following ratios. How many ratios over 2 years?
4.
How many ratios?
4 ratios.
4 ratios. How many marks?
8 marks.
Good. Read the B parts.
Based on the ratios computed above, prepare a report on the performance and state of the company, assuming potential shareholders and lenders are the recipients of your reports.
Very good. I am not interested in the computation. And I know you are not interested in that because we've discussed computation, like, that's what we've basically been discussing. So let's still go ahead with the interpretation. Now, this is the reality for professional guys, even in CR, where we are not paying so much attention to the calculation. You see your interpretation carrying more marks. Are we together? So that's what you see here. So what I want us to do now is someone with a very good network, fantastic network. We will go to this report and we need to read it in full. There are so many things we need to get when we are reading. A lot of time you are asked to write a report to interpret your ratio. We need to know how to do that. Also, we need to be able to organize our report properly. So now let's go to question 2. I think I would even prefer to use this May 2016. But let's go. It's fine. So I want us to, is this one long enough? So this format is not even given, but let's just run through it fast and go to that November 2016 and use that one to close it before we just touch base with case study. So now I wanted to emphasize on report template to say you need to actually, when you are asked to write a report, don't just jump and start writing. Try to put a report template by dating, put a date, put a simple memo to say, oh, from to who, to maybe the shareholders or the lenders, right? Address your reports properly. By who? Maybe an accountant or senior accountant or CFO, whoever, depending on the information available, right? And then you can create a proper subject, which is like what they have here. Report on the performance of this, report on the performance and state of the economy. But let's read. I need someone with a very good network to read.
Report on the performance and state of the company.
Yeah, someone is already reading. I think we can listen.
This report is based on the financial state of AZ, that is A to Z, that is considering raising external finance through offering of its shares for sale or obtaining term loan from the bank. Profitability ratios. These ratios measures how well the entity is performing in the area of returns. The higher the ratio, the better. Return on equity, ROE, is a measure of how effectively a business uses equity or the money contributed by its shareholders and cumulative retained earnings to produce income. In other words, ROE indicates a company's ability to turn equity capital into net profit. A to Z ROE, point number 2, A to Z ROE has increased from 15.9% in 2020 to 19.4% in 2021, which indicates an increase of 3.5% year on year. This is a good indication for the company because it shows that the company's management team is more efficient when it comes to utilizing investment financing to grow their business. This is more likely to provide better returns to investors. Shareholders slash potential investors ratios. Dividend cover ratio. This is a financial metric that measures the number of times that a company can pay dividend to its shareholders. From the ratio computed, the number of times increased from 3.8 times in 2020 to 5.3 times in 2021. This shows a good improvement on the part of the entity. Dividend payout ratio. This gives us a clearer picture about how much the company gives back to its shareholders as part of the total profit earned in form of dividends, and to what extent it is plowing back the profits for future investments, repay its debts, and add to its cash reserves in this case. In this case, there is a reduction from 26.7% to 18.6%, which implies that more funds is plowed back into the basis. Interest cover ratio. This is a measure of the number of times a company could make its interest payments with its earnings. The result above shows the profit before tax can cover more times of the interest as it increased from 10.5 times to 12.9 times. Conclusion. It can be concluded that the business state of affairs currently is stable and acceptable. The business has improved on our performance between 2020 and 2021. A to Z investors and lenders ratio are favorable due to increase in profitability as evidenced in the ratios calculated for the period. The management was able to return 19.4 naira for every 1 naira invested by the shareholders and covers interest on loan comfortably due to improved profitability for year 2020 and year 2021. Management should maintain and surpass this performance for the future. Thank you. Yours faithfully, Mr. ZXY.
Okay, very good, but a very shallow analysis, anyways. And what I also want to tell you is that at professional level, at skills level, this might be a good report, right? But at professional level, um, I mean, that's why sometimes you also don't need to, you know, just bank 100% on these pathfinders. I would expect that 12 marks, you do a lot more and be more specific. If you have wasted, do you know how many space you've wasted explaining what the ratio is in each of these paragraph or or each of these number? So I don't even need you at this level to go and be explaining to me. ROE is a ratio that indicates that, and then you first of all explain. I mean, I was tempted at some point to say I want to go back to the requirement to really see what it is, what they ask us to do, because as an examiner, I won't accept that approach. I won't accept it. Based on the ratio computed above, prepare a report on the performance and state of the economy, assuming potential shareholders and lenders are recipient of your report. Okay, maybe they consider the audience now to assume that it's not all of them that would know the purpose of each of the ratio. Will that make sense?
Yes. I was
That's
Yes,
the
I
only
thinking
way
think
I'll
it
take it.
does.
something. The others are probably they explain it in a way that the ordinary man that's a shareholder understands
Exactly.
what it means.
Exactly. Exactly. This is the only way it will be acceptable to me. Assuming that potential shareholders and lenders are the recipient of the report. And those are tricky things that we need to pay attention to when we are reading our requirement too. you know, for me to read that, highlight it, come back and say, I want to come and see a reason that must have made me to do that. Then it tells you that, doing well in ICAN examination goes beyond, you've read, you want to just go and scatter it. No, you must also know how to interpret know what you're expected to do. It's very, very key. Okay. For case study is very paramount. Knowing your audience, knowing whether it's an external or internal report, knowing a whole lot of things is connected there. Okay, so that's it. Let's do something more interesting. This question two, May 2016, and I'll do a walkthrough the question, and then I also need somebody with a very perfect network to read through the solution. It's a long one. And then this will be the last one. This is the last one. And after we are done with this, like I said, I need you to actually review all past questions on financial statement analysis. All past questions for CR and FR guys. I need you. It's an assignment. I need you to do that. I will drop a poll on the WhatsApp group and I will need you to indicate there once you have attended to it. It's very, very important. Okay? So that I can see the list of people who have done it and people who have not done it. Now, this question is a long one. A public company, that's is Marvel. A public company is a high street retailer that sells clothing and food. The managing director is very disappointed with the current year's result. The company expanded its operation and commissioned a famous designer to restyle its clothing product. This had led to increased sales in both retail lines, yet overall profits are still low. Extract from the income statement for 2 years, 2016 and 2015, as shown below. And then they gave us revenue broken down into clothing and food. And then cost of sales also broken into clothing and food, and then gross profit. And then the company's cash flow statement is given, showing us the net profit. They used indirect method, showing us net profit with adjustments, and then they have a positive operating profit for a positive cash generated from operation, and even after deducting interest and tax, they still generated a positive net cash from operating activities. And then on the cash flow, I see I'm just providing you with some information already. On the cash flow, there we see that they incurred significant amount in purchasing property, plant, and equipment, and then they disposed features which amounted to a very insignificant amount. And overall, they incurred significant amount in their investing activity, and that led to a negative investing activity amount. And on the financing activity side, they issued ordinary share during that period, right? During the year 2016. And then also, which one? Also, they issued long-term loan. Wow, both shares and long-term loan. Interesting. 3K, 2K, and then equity dividend was paid 600, and that is how they have this positive fine inflow from financing activity. But if you look at everything, I'm then connecting it already. They issued all these things. They get this money. Maybe they added some money with the money they got from operating activity and then invested in property, plant, and equipment without doing any analysis. I'm already making this, getting this insight. Okay. And then they went further to, okay, they had this cash opening balance. And then at the end of the day, the cash balance is even negative because what they have as opening balance plus what they got from issuing shares and loan and what they got from operating activity is not even enough to cover what they paid in buying a non-current asset. And that's why they have a negative cash and cash equivalent at the end of the day. Are we together? And then they went further to say you have been given these ratios to tell you how unimportant your ratio calculation is at this level. They gave you a calculation of ratios that have been calculated already for 2015 and 2016. Return on capital employed, net asset turnover, gross profit margin, both clothing and food, net profit margin, both current ratio, inventory holding period, both clothing and food, accounts payable period, gearing, interest cover, and then I've literally analyzed all this for you, and I hope you were listening. The following information is also relevant. They said the floor area in square meter occupied on each of this year is clothing occupies this, food occupies this, and number two, the share price of the company averaged 6 naira during the year 2015, but declined to 3 naira in 2016. Now, direct question. Write a report analyzing somebody mute so that you will not distract us. Write a report analyzing the financials of A Marvel PLC, utilizing the above ratios. They've done the calculation for you, right? And the information in the statement of cash flow. Consider those information in the cash flow, which I've highlighted for you for the 2-year period 2016. Your report should refer to the relative performance of the clothing and food. When you are doing your analysis, anywhere you need to make reference to food or clothing, whether food is contributing more or clothing is contributing more, or whichever one is really doing bad, just eating our money, highlight it properly. And your report should and be supported by any further ratio you deem fit to calculate, right? Just to tell you, maybe you are interested in additional ratio. You've said they've not completed enough. Feel free to do it, and we just want you to write a report. And at the end of the day, get a 20 marks for it. This is a good question that I really want you to sit down and take a look at on your own. But let's just read through some parts. And is that not question 2? Question 2, question 2. Yeah, so it's a long one, as you can see. It's 20 marks. They don't want to waste your time. This is very good for you too, those of you writing case study. So this is a good format that I like. A good format in terms of report structure. So who is reading for us? We won't read everything, so don't be scared. I think the first reader, if you're even able to read, is long. You have to take this home anyways. Let's just focus on profitability, operating performance for now. So, and we close it there.
Okay. Date 17/05/2016. The Managing Director, Ehis Marvel PLC. Dear Sir, the financial performance of ACE Marvel PLC for the 2 years ended 31st March 2016. Introduction. Our discussion on the above subject matter refers. The report assesses the overall performance of ACE Marvel PLC. This is subdivided into operational performance, liquidity/solvency, and share price/dividend, ending with a concluding remark. Operating performance. The overall performance of the firm is usually measured by its return on capital employed, ROCE. Applying this to ACE Marvel PLC, this ratio has seen a significant deterioration from 33.9% in 2015 to a low 9.3% in 2016. The cause of this deterioration can further be broken down into the component part of the ratios making up the rows, which are asset turnover and profit margins. The asset turnover, which measures the effectiveness of the firm in utilizing its assets to generate income, fell from 3.3 times in 2015 to 2.1 times in 2016. This can be interpreted to mean increased inefficiency in asset utilization, partly contributing to the deterioration in ROCE. However, the company embarked on a huge investment, acquiring 5 new stores, which must have significantly increased net assets. It may be that this new investment has not started to generate sales at the level of existing capacity. As such, asset turnover may not be as bad as it appears and is bound to improve in future. The gross profit margin for the clothing sales appears to be major issues with deteriorating ROCE, as it dropped by about 98% from 18.6% in 2015 to 9.4% in 2016. The effect of this appears more pronounced in terms of its huge impact on ROCE, because clothing sales accounted for about 70%, 16,000 divided by 23,000 times 100% of the company's total sales in the year. In addition, there has been a noticeable increase in the inventory holding period of the clothing products to 68 days in the current year, up from 39 days in 2015. This may be interpreted to mean a deliberate policy on the part of the company to stockpile in order to attract and meet more sales, but may in the alternative be seen as evidence of obsolete and slow-moving inventory. One other concern with the clothing sale is being exposed to the change in fashion. This has implications on its sales and inventory, given that there may be new designs and may fail to gain acceptance in the market. On the other hand, profit margin for full sales has witnessed a moderate improvement by about 28%, increasing from 25% in 2015 to 32.1% in 2016. This has helped to reduce the impact of the fall in the profit margin of the clothing sales, and hence the overall effect in ROCE. Engaging in a deeper comparative departmental analysis confirms the above position. For example, there has been an increase of 35% in total sales floor area that has resulted in a mere increase in total sales of 17.3%. A further breakdown of this on a departmental basis shows that for the clothing department, an increase in floor area capacity of 37% resulted in a mere increase in sales of 2.6%, while a smaller 20% increase in full sales area produced an impressive 75% sales increase. Likewise, there has been deterioration in clothing sales per square meter this year to 333,000, down from 446,000 in 2015. And this is in sharp contrast to the substantial increase in full sale per square meter of 1,167,000, up from 800,000 in 2015. This resulted in overall total sales per square meter of 426,000, down from 490,000 in 2015. Not unexpectedly, The firm's net profit margin fell from 7.1 in 7.1% in 2015 to a mere 2.0% in 2016. This is an indication that overhead expenses increased substantially as a result of additional sales outlets and the attendant marketing cost. Taken together, the insight gained from the above further analysis point to full sales delivery increasingly more profitable, more profitable, more profitable returns on investment than clothing sales. But the firm has invested more in clothing floor area than food area, therefore focusing on clothing sales for capacity increase rather than on full sales appears misplaced.
Now, thank you very much for reading through. I mean, that required a lot of energy, and thank you. So, I just wanted us to read through. It's still a very long reading. You still have liquidity, very long notes. You have share price and dividend, very long note before conclusions. And for those of you writing case study, this is one report I need you to take home tonight and go and do a personal review on it, right? Review the reports, alongside with the information that have been provided in that ratio, the cash flow statement, and the other statement that have been provided. And the first thing I really want you to get is how to really, the languages, how to tailor your report is very, very important. I've mentioned before that you cannot be analyzing numbers like an engineer. You cannot be analyzing like a car dealer. You are a number expert, right? A financial mogul. What do I call you now that can, just help, like I motivate you to give me big grammar. Okay, I'm just joking. But to be very frank with you, how you interpret your numbers really matters. And especially for those of you writing case study, it's called a professional report. So that report assumes you are working in an advisory capacity and you are solving a problem for your client. And even when you are not solving a problem for your client, let's say you are solving an internal problem, meaning you are writing an internal report. You are probably writing a report like this, where you work for AE Marvel PLC, and you're writing to your MD, analyzing the performance of your company, right? You probably work in the economic advisory unit, or maybe any of the unit that provides this insightful report to the CEO or to the managing director to be able to make informed decision, right? So whether internal report or external report, is still the same thing. Just know your audience and provide that professional report, right? Case study guys and CR guys as well. For case study guys, you must take this report away. You must go and digest it properly. And then on the last notes now, right, is just for you to use this report which we have used. This is strictly for case study guys. To use this report which we have used in our previous classes to discuss our approach to case study. We've discussed every other aspect. We don't want to even touch anything in this class. But the only part I just want to show you is that if you are dealing with a report like this, which says you are doing an analysis of DD Communication Nigeria Limited's current financial position, analyzing the viability of proposed expansion plan and all of these things that are under consideration, and then on the basis of that, you wrote your executive summary, you wrote your introduction, you did all of these things, and then you get to this aspect that you then want to do your financial statement analysis in session 3. Everything that we have been discussing is relevant, right? You need to be able to do your common size analysis, probably touch a touch of trend analysis as well. And then you also want to be able to say, okay, what are the categories of ratios that I want to, time will not permit us. I would have said, let me open this diet so that we read the requirement and see the nature of ratios they expect you to do, right? So, but you want to, so all you need is to remember your categories of ratios from your profitability to efficiency to liquidity to long-term solvency and your investment ratio, and be able to calculate appropriately, and then come in here to bring up your appropriate subheadings and do your analysis. The interpretation part, right, is just as good as what you can get here in terms of this sample report and the Pathfinder that we just finished looking at. The most important thing is know your audience and be mindful of the language you use, right? Don't interpret ratios like a pepper seller. I'll call you out in that class when we start reviewing reports. So you need to show me that you've gone through this report very well. You've gone through the lectures, you've gone through all this report that we just finished reading. You need to be able to interpret. Rose increased from 5.3 in 2016 to this in 2015 or 2017. The decline in ROCE is attributable to the decline in asset turnover despite the increase in net profit margin. A deeper look at the asset turnover shows that the total asset or the total capital employed increased significantly during the year. But this increase is attributable to the revaluation surplus, which is only an artificial increase in the asset, and does not necessarily mean that the company has purchased any additional asset during the year. In conclusion, the company's performance improved during the year, as seen in the revenue and even the profit for the year, which increased by a social percentage. And you have to be able to tailor your things properly, and that's why I said, if you look here, you have a simple approach here where you need to be able to show comment on your numbers, take a deeper look, state possible reasons for the changes, and conclude on your ratios. Very, very important. We read the report now. You see them making reference to a project they just commissioned. Maybe that project is not even generating enough revenue yet, even though they've pumped in so much money, because it's a new project. We might not be coming in fully yet the way we expect. Maybe the coming year, we expect that project to start turning in cool cash, right? So you want to be able to, break things properly. This is a very important topic. And you can go on and on to check your past question trend to really emphasize, to see how important this is. You can almost be certain that you come across it, right? Even maybe two of your subjects, FR and maybe PM or PSAF, for professional guys, certain in your CR and case study, you can probably come across it in SFM as well. And for case study guys, now the last comment will be that once you've gone through that report on your own, all we then need to do is to have our first assignment. I know you still have some classes like review of models that you'll be having soon, but the next thing is you are ready for assignments. You are ready for assignments, case study guys. So expect my message on the group on your first report assignment, of which we've discussed the rules before. So you know the fines that you have to pay for any non-compliance, and you know what is at stake. So let's comply, and then we can make best use of our time. So once assignment is given, ensure you start working on it early. Don't wait till last minute. It is always not easy if you wait a day before deadline to submit, right? And that's it for case study, guys. Questions, and then we can go. Nazar, go ahead with your question.
Please, can you reshare this report again on group chat?
This particular one?
Yes.
Is it not in your case study folder? I think it should be. I will check. If it is not, I'll drop it in that folder. Yep. Any other question? Time has really gone.
No, sir.
All right. So thank you so much. Thank you for your time. And it's been a very long one. But I know we've gained a lot. I will expect to see all of this in the reports that case study guys will be writing. In your CR, just go and clear it. Once you see financial statement analysis, clear it. FR, clear it. if they now mistakenly bring it out in PM, SFM, or PSAF, I mean, just close your eyes and clear it. So thank you for your time and have a very lovely week. Bye-bye.
Yes, I want the case study.
Thank you.